Welcome to the PhillipCapital Studio Weekly Market Watch. My name is Sim Han Chiang and I'm an investment analyst with Phillip Futures. This week, I'll be discussing the debt situation in Greece. Firstly, let us take a look at the chart that shows the 5-year Greece credit default swap. The chart measures the cost of protecting against Greece's sovereign debt default. The data points are from March 2011 to 19 September 2011. The cost of protecting against Greece's sovereign debt default reached a high of around 5,750 basis points before central banks intervened to provide liquidity to the European banks. As you observe in the chart patterns, the news of central bank intervention brought temporary relief before the cost spiked again to a new peak. Currently, it will cost almost 6,000 basis points to insure against a Greece default. At this level, the market is implying a default. The next chart shows the 1-year Greece government bond yield. The data points are from September 2010 to 20th September 2011. As you can see in the chart, the yield on a 1-year Greece government bond went up as high as 140% early this month. That was before central bank intervened to provide liquidity to European banks. Since then, the 1-year Greek bond yield has come off and currently stands at 124%. The bond market is pricing in a very high likelihood of default at this level. I believe that a Greek debt default is very likely. Even if there is another bailout in the near future, it would just be a delay method, similar to kicking the can down the road for another few months. Suppose Greece agrees to implement new austerity measures and receive another tranche of bailout funding, applying severe budget austerity measures in a Greece economy that is in a recession does not materially close the budget deficit. Instead, it produces further economic weaknesses and revenue shortfalls. We can see a clear example of that happening over the past year. There is an enormous debt burden for Greece to service, let alone the high interest that accompanies it. A bailout in the near future, if there were to be one, does not avoid default. If it would likely just defer the default to a later date and would be squandering funds that could otherwise be used to recapitalize the European banking system. Thank you for watching Weekly Market Watch. Tune in next week.